Hi, Dr. Dali. I want to ask you what you think about the Dragon portfolio offered by Chris Cole at Artemis Capital. Obviously, this is actively managed fund, and it is very interesting because he had talked about having a diversified portfolio management strategy, having equity that contains domestic, international, as well as other strategies such as trend following, commodity, physical gold holding, and obviously US Treasury. The aim is to protect from deflationary, inflationary, or severe volatility to preserve principal and take advantage of the equity on the upside. I know it's actively managed fund and it has a higher managed fee. Just want to get your opinion on that. And I'm currently a passive investor, only in investing in the index funds. So I want to learn more about what you think about this fund particularly. Thank you.
Okay, the most important thing in investing is that you pick a reasonable asset allocation, a reasonable portfolio, and that you fund it adequately and that you stick with your plan over the long term. That's the most important thing. Okay, I've got a post on the blog called 150 Portfolios Better Than Yours. And it's a list of now 200 different portfolios and what I think of them. And every one of them is reasonable, right? Reasonable people can disagree on how much you ought to have in stocks or bonds or whatever else in your portfolio. But you want to avoid having anything really crazy. Okay, that's the idea, is to avoid crazy portfolios. And I occasionally even give examples of what crazy portfolios look like. But so let's talk about this Dragon portfolio. What is the Dragon portfolio? Well, it's 24% stocks, 18% bonds, 19% physical gold, 18% commodity trend following, so basically market timing of commodities, and 20% long volatility, actively managed long volatility. So I'm not necessarily against you having any of that in your portfolio. But when you get into the more weird stuff, the more alternative types of investments. When I'm talking about alternatives, I'm talking about anything but stocks, bonds, and real estate. Okay, when you're getting into those sorts of things, whether it's cryptocurrency, whether it's gold, whether it's long volatility, whether it's commodities, whether it's beanie babies, whatever, you're getting something a little weird. I think you ought to limit how much of that you have in your portfolio. And the typical amounts I give are 5 to 10%. Okay, I think the rest of your portfolio ought to be in stocks and bonds and real estate in some combination. Those are long track record, proven assets. Okay, where does a portfolio like the Dragon portfolio come from? Well, it comes from somebody doing a bunch of back testing, right? And then presuming the future is going to look like the past, which it usually doesn't. That's how these sorts of portfolios get built. And these ones that are trying to be every market kind of portfolios are particularly concerning to me. There's a Dalio. I think he had a, what do you call it, all-weather portfolio. There is the permanent portfolio. And each of these comes with this idea that even in terrible market situations, they'll do okay. The problem is most of the time in history, it is the triumph of the optimists. It feels so smart to be a pessimist, but most of the time the optimists are right. And so you want most of your portfolio geared to do well in good times. So what assets do well in good times? Well, stocks and real estate tend to do well in good times. If you put most of your portfolio into stuff that doesn't do well in good times, the drag from the good times is so much that overall you do poorly. Okay, so let's look at this particular portfolio. It's got basically 24% of the portfolio in stuff that does well in good times. I don't think that's enough. Not for anybody who's actually trying to grow their assets and trying to let their portfolio do some of the heavy lifting of saving for retirement, right? I mean, I've got quite a bit more than that in portfolios that do well in assets that do well in good times. My portfolio is 60% stock, 20% bonds, 20% real estate. Okay. And in good times, 80% of that portfolio is doing very well. The last 10 years, it has really rewarded me. It's made really good money. And maybe in the next 10 years, it doesn't do as well. But you know what? The 10 years after that, it probably will do well again. Now, I don't know exactly what the markets are going to do in the coming decades. But when I see a portfolio that has this much of it, over 3/4 of the portfolio dedicated to weird environmental situations, I say that's kind of a crazy portfolio. So I wouldn't recommend the Dragon portfolio. I don't think it's a reasonable portfolio. A few other things that I don't like about it, aside from the fact that more than 5 to 10% is in these unusual asset classes, right? This thing's recommending, it looks like 58% of the portfolio into these weird asset classes, right? Physical gold, commodity trend following, and actively managed long volatility. It makes me wonder, well, who's recommending this? And you mentioned Artemis and Chris Cole. Well, guess what they manage? Guess how they make a living? That's right. They make a living by collecting assets under management that invest in funds like long volatility and commodity trend following, right? This is how they make their money. So, of course, they think you ought to have a whole bunch of your portfolio into this stuff, right? They've got this volatility fund. And so they say, put 21% of your portfolio into it because they will know that no smart investor is going to put the whole portfolio into it. So they sit around a table and go, well, how much of it do you think we can talk people into putting in? Well, let's put 21%. That sounds smart. And so that's where you get something like the Dragon portfolio. And then you attach a whole bunch of marketing to it so people like you find out about it and start going, well, that sounds pretty smart. Well, if you really dig into the details, you start asking questions, right? For example, how is a retail investor supposed to implement the active long volatility component of the portfolio, right? Well, the only way is through these Artemis run hedge fund. So it makes you go, well, maybe this is just, a Trojan horse for Artemis to get you into their fund. But even the back testing, you got to wonder about this because there wasn't any sort of an ETF that invested in volatility until 2009, right? That's the VIX. And so you really can't even back test this adequately. It's basically a guess that it would have done well over the last 100 years. And so I don't have a lot of faith in such a biased, back-tested investing method. I don't have a lot of faith in active management. And I think this is probably a portfolio filled with investments that are sold, not bought. And so I wouldn't give a big recommendation for it. If you're totally convinced by Chris Cole and his explanation, knock yourself out. You can invest in his funds and you can adopt the Dragon portfolio. But like any other portfolio, keep in mind, you're going to have to stick with this thing through thick and thin for the next 30 to 60 years. There are going to be long periods of time, like the last 10 years, when U.S. stocks, international stocks, whatever, are doing really well. And you're going to look at them and go, man, I only got 24% of my portfolio in those. Wish I had more instead of all this money I've got in long volatility and commodities trend following. Hope that's helpful to you. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.